Okay, it looks like the numbers are leveling off, so everyone who's wanting to join has joined. Good morning, everybody, and welcome to this January edition of our Economic and Investment Update. My name is David Baker. I'm Chief Investment Officer here at Mazars, and I'm joined, as always, by our Chief Economist, George Lagarias. So, I think we last spoke in November-ish, and obviously a lot has happened since then with the development of the Omicron variant and central banks talking a lot about monetary policy. So we've got a lot to cover. As ever, if you have a question, please do put it in the Q&A box as opposed to the chat box, and we will try to get as many questions dealt with as possible. We've had quite a few in advance, so apologies as always if we don't get to your question live on the call. So let's kick off then with the first slide with just a review of what happened in 2021, and probably worth doing this because we probably need a little bit of good news. So let's start with the good news. It was another brilliant year for risk assets and equities in particular. So you can see US markets nearly returning 30%, Europe and the UK less so, but still very strong equity returns, particularly considering that economically we were all still largely struggling with the COVID pandemic. So a really good year in 2021 for equities, less so for bonds. So look at the middle part of that screen where you're looking at US Treasuries, non-gilts and gilts, actually negative returns on that stuff which is supposed to be the steady low risk asset classes within the portfolio. And then just on the far right you can see pound actually strengthened quite a bit against the euro, not against the US dollar. It was fairly flat in the year, but certainly strengthened against the euro during 2021, which is of course a factor as a sterling-based investor. One has to think about currency fluctuations as well. And of course, within our portfolios, we do hedge around half of the currency exposure. So good year in 2021, that off the back of the previous year, 2020, which despite all of the economic woes and healthcare difficulties, again, was a really good year for risk assets as central banks pumped money into the markets. So around 13–14% in sterling terms from global equities last year. And then on top of that, this really good year that we had in 2021. So that was all lovely. But then we get on to year to date in 2022. If we go to the next slide, we can see that it's been the worst start for all assets if you consider that over the last 20 years or so. So what we're looking at here is not just equities, but a combination of half UK equities and half US Treasuries. So what you might call a US dollar balanced portfolio. And you can see 2022 on the far left hand side minus 4.8%, and that has beaten the two previous worst years, which were 2008, 2009, which of course was in the heart of the global financial crisis. So this hasn't come as a great surprise because we've seen this developing over the last 6 to 12 months, inflationary pressures coming from the pandemic, and that forcing central banks to start to think about A, raising interest rates, and B, reducing the quantitative easing, reducing the amount of money going into the financial economy, and indeed thinking about starting to withdraw it out. So that massive cushion of liquidity, which has been supportive of stock markets, we're thinking now about that being taken away. And we've also spoken in these sessions before about some of the bubbly behavior that we've seen in equity markets. We've seen very high valuations. We've seen a lot of participation from retail investors, some of whom highly leveraged, which is quite a risky way to access stock markets. And we've seen the likes of private equity and these special purpose acquisition companies with a lot of cash trying to find a home, and all these things tend to be indicative of markets that are perhaps a little overvalued. And this is common knowledge. Everybody's been reasonably nervous about equity valuations. But whilst you've got the Fed sitting behind markets, you take a degree of comfort from that. And that's really what has changed over the last month or two, and why markets are very nervous, very jumpy. And indeed, if you'd have watched the US stock market yesterday, it was down 4% in the morning. That's a huge move in a day, a month, a year. Well, maybe not a year, but you know what I mean. It's a significant move. But to be down 4% in a morning and then finish the day in positive territory tells you, everything that you need to know about the state of markets at this point in time. So 2 very good years, a lot of nervousness to start this year with, and I'm sure George will touch upon the outlook for the next of the year. So let's move on and just drill down a little bit further, because we're concentrating on that slide on the US, but there has been some discrimination, certainly geographically, with what has done poorly in the first part of this year. And you can see at the bottom there, S&P 500, the US market, and Japanese equities really taking a very hard hit. But by contrast, second from the top, FTSE 100 UK equities have really been largely unaffected. Of course, remember, the UK stock market has been very much out of favour over the last few years. So this is really a story of markets that have had very strong returns in recent times, giving some of that back in the first few weeks of this year. Notice also that we're not just looking at equities on this chart. Fourth from the bottom, you've got global investment grade bonds. So the fixed income market is being affected by this downturn. And indeed, you've got gold and oil and other general commodities on the chart as well. So generally speaking, in markets, a lot of people taking money off the table for the time being, at least. So some discrimination from a geographical perspective, and indeed within geographic markets, further discrimination. If we go to the next slide, you can see one of the funds that we use within our portfolios, which is the dark blue line A, which is the Dodge & Cox US fund, and that's compared to the lighter blue line B, which is the S&P 500. And this is performance in the first 21 days of this year. And there's a huge differential between the two, over 6% gap between our Dodge & Cox fund and the US market. And this was a fund that we put in about 6 months ago because we were aware that there was the possibility of this rotation out of the growth funds, those that looked quite a way into the future for a significant growth in the company and their earnings, and the value funds, those that were established and maybe a little bit more boring, but were churning out dividends and returns to their shareholders today. So we were aware of that, and we transitioned a little bit into this Dodge & Cox fund. So within the portfolios, we still do have exposure to the growth stuff, but fair to say that the market is looking to rotate out of some of the winners from the previous years and rotate more into things that did less well during the pandemic and certainly during lockdowns. So I said equities that have been expensive for a couple of years, and now obviously they've sold off a little. That doesn't mean that they are cheap, although you might well make an argument for emerging markets in the UK and Japan. But on a global basis, and certainly on a US basis, they still look reasonably expensive against their 10-year average. So this sell-off has done a little bit to alleviate the fears of those people who think equity markets are expensive. But you could still make an argument for equities to fall further if all you were focusing on was the price to earnings ratio. It's certainly not a screaming buy at this stage. So everything was expensive. We've had a sell-off. It's still reasonably expensive on the equity front. What about bonds? The next chart tells you that the pattern in markets and what is affecting equity markets is essentially happening in the bond world, and essentially as a symptom of inflation and monetary policy. So we've seen some quite startling inflationary numbers in the US, in the UK, and in Europe. They will start to come down over the course of this year, but not necessarily to a level that is at or below the targets that central banks have in those countries. So whereas the conversation 12 months ago was an expectation of inflation, but it being largely transitory, i.e. it's just caused by supply side issues, and once supply chains reopen, that inflation might go away. We've now moved to a stage where you're seeing wage negotiations and the whole psychological element of inflation becoming more embedded in the public psyche, and that has led central banks to be much more hawkish in terms of their rhetoric about the path for interest rates in 2022. So as a result, you've seen yields on US Treasuries and on UK gilts being pushed up quite significantly just over the course of 2 or 3 weeks. So you're being paid more for owning those assets, which is good news, albeit with the amount of inflation in real terms, you're effectively locking into a negative real return if you're buying any sort of developed market sovereign bond. And then on the right-hand side, we've got the corporate lending market. If you're lending to corporates rather than to governments, you can obviously get a little more return there, but albeit those lines are starting to tick up in the last few weeks, not to anything that looks like a particularly attractive investment opportunity. So despite the sell-off, everything's still looking reasonably expensive. One final chart for me before I pass to George, and that's just a pickup on the theme that emerged very much throughout last year, and we think is going to persist for the rest of this decade at least. It's sustainable investments, those that are badged ESG, and in this case we're using the MSCI index. It's not perfect, but it's suitable for this illustration purposes. Sustainable investments beat the MSCI World Index, and we think that this is a theme that's going to play out some more over the next decade. We often, when we ask for questions, we often get questions on ESG, and I'm minded, if there's demand for it, to do a special ESG edition of this webinar in the next month or two. So if that's something that would interest you, please do let us know, and we'll put something on with that, and we'll get some of our other colleagues involved who specialize in that area. So that's what's happened in the last year and the last few weeks in markets, and I'll pass to George to take us through what sits behind all of that.
Thank you, David. So one thing we have to remember about the pandemic is that it's going to have some long-lasting effects, starting with debt. When the pandemic started, governments spent a lot of money supporting small businesses that were under pressure, especially before vaccination was made available. And of course, they did spend a lot of money on vaccinations, and they did spend a lot of money on the healthcare systems. That money simply they didn't have. So they borrowed a lot of it. In the next slide, you're going to see the OECD's projection about where we end up after this pandemic, maybe in a couple of years' time. So Japan and Greece will still remain the most indebted nations in the world based on projected GDP. Italy is also higher, and Italy, for those of you who have been watching markets for a few times, it's never good if it has more debt. Great Britain is one of the countries that has incurred the largest debt to fight the pandemic. So believe it or not, at the end of 2023, Britain is now projected to be at the same debt levels in Italy. and the US is catching up. So we are faced with a world that will have a lot and a very big debt hangover. And this will have massive implications for interest rates, for government borrowing, for politics. So we'll talk a little bit more about that. Now, in the next slide, as David said it, we have seen some record inflation numbers. Inflation numbers, first of all, inflation is something that went missing back in 2000 when China was coming into its own. Things that were imported in Western economies became a lot cheaper. So China exported deflation. China is now going through a transitionary period, plus there were all those disruptions with the pandemic, the supply chain disruptions, and that has caused a massive inflationary surge. So we have not seen inflationary numbers like the ones we see today in the US since before Ronald Reagan was inaugurated president. And of course, that is raising eyebrows, and not just for the Fed. In the next slide, what you're going to see is wage inflation, inflationary wage pressures. So about 59% of Americans want to renegotiate their salaries upwards. About half of Americans want a raise above 3 or 4%, up to all the way up to 25%. When inflation is 7%, 3 or 4% seems very modest. People are still losing money. So what really happened, and that's really where the Fed miscalculated. The Fed thought that this inflationary surge, as David said, it's going to be transitional, transient, and when supply chain pressures abate, we should get back to normal, repressed inflation of below 2%. But that inflation persisted for nearly a year. And when people see inflation for about a year, they start to get scared, and they go to their boss, who was usually able to have an easy negotiation. Hi, this is your next year's salary. You're up 2%. Thank you very much. Now, if somebody says your next year's salary is up 2%, people will say, well, that for me means that you've curtailed my salary 5%. So I want more than inflation. And the more those numbers persist and they make the headlines, the more inflationary pressures from the demand side now are increased. And demand inflationary pressures, wage inflation in specific, tends to be a lot more sticky. Okay, once those wages start to take the uphill, there's no telling where they might go. So the Fed did an about turn. In the next slide, you're going to see rate projections for the next year. And as you're going to see, the projections are for about 2 to 3 rate hikes for the US. Right now, it's nearly more near 3 than 2. 3+ rate hikes for the UK. Interestingly enough, the EU is still and the ECB are still much more dovish. Why? Because labor markets in the EU are more rigid. It's more difficult to get fired, but it's more difficult to go and negotiate a raise. And there are all sorts of benefits included and safeguards for employees and all of that. So that's why it's a very different labor structure, and that is why the ECB hasn't panicked yet. I also believe, and this is more of a personal opinion, that they do plan to try to keep the euro a little bit cheap to boost exports and help economic growth. They haven't said as much, but their moves sort of indicate that. Or else I would expect to see a lot more pressure from Germany, especially to increase interest rates. Now, in the next slide, and really this is where it all wraps up. is how the Fed is thinking. For the past 12 years, the Fed was like this overprotective parent. You know, every time the markets had the fit, they would go and give candy to the markets. Quantitative easing, here's more money, take it, take it, take it, take it. And that was okay because none of that money was inflationary. But now that we have actual bona fide inflation, the thing we haven't seen in 20 years, they got panicked, and their primary, their primary mandate is not to support risk assets, it's to combat inflation. So now they need to shift towards that and start raising interest rates. There are some investors out there who believe that even 3 interest rate hikes next year might be too optimistic. There could be more than that. And financial risks are taking the back seat. So quantitative easing, for now, it's done. Now, we don't believe that it's done forever. We actually think that if market volatility starts peaking, if we see a lot more market volatility than what we have seen since the beginning of this year, the Fed might reverse the scale and say, okay, now I need to make sure markets are stable. And don't forget, especially for America, a lot of people have money in their retirement accounts, and they can't really afford big stock market gyrations. So, you know, you might be losing money from inflation, but you're also losing money from your stock and bond account. So there are conditions under which this thinking might be reversed, but you would need to see a lot more volatility. Currently, the S&P, including today's futures, is down maybe 9.5% since the beginning of the year. Sorry, from its peak in late December. This could be all the way up to, I don't know, 20-30% even before the Fed reacts. And that's what really changed. The Fed used to react at a -5, -10 at the most. Now it's going to take a lot more for the Fed to react. Next slide. So we're out of this quantitative easing regime. And into really we're transitioning not just to where we stopped QE, a process by which the Fed retains the liquidity it has injected into the market, it just doesn't add to it, but also quantitative tightening, taking liquidity away from the market. Generally speaking, when you have QE, average equity returns were about 25%. Last year they were 26, spot on. Now we're entering a regime, we are in the tapering down regime, but this won't last long. By March, the Fed might have finished with quantitative easing altogether. And it could start even tightening very, very soon thereafter. So we're looking at returns from 10 to 7% per annum. It's still not bad, it's still positive. And by the way, equities love inflation because you can't really keep the cash in the bank or in bonds, which have very low yields. So equities is a natural place where money tends to go in inflationary times. And speaking of bonds, next slide. One thing everybody with an investment portfolio needs to be mindful of is that the downside for bonds is significant. So what happened in the last few years, bond yields were very low, and that means the coupon that you received for each bond was also very low. And what happens, it's a strange financial concept called convexity. It's a relation between the price and the yield, but the gist of it really is that with so low coupons, when yields drop, when yields rise, prices drop even more than they did in the past. So just to put it in numbers and based off of some quick and dirty calculations, if the bond yield for the US 10-year reaches 2%, this will mean roughly a 5-6% drop for the price. If it goes all the way up to 4%, that could mean a 20% drop for the world's safest asset, the bedrock of portfolio construction. Okay, so we are in a place where bonds are, despite what historic volatility indices might suggest, bonds are also in danger. Um, especially as there are assets that have really benefited from quantitative easing. Now, this is where the bad news stops and where I'll stop depressing people. In the next slide comes the good news, and the good news is that residual liquidity is plenty. Residual liquidity means, after all these years we have injected liquidity into the system. There is a lot more money, and it needs to be absorbed by the by markets. So in the first round of QE between 09 and 19, we added about 10 trillion. The major central banks, US, EU, Japan, and China. And in the next round, just the last 2 years, we added another 11. Okay, previous slide. Sorry, Harry. That moved a little bit too fast. And then there is government liquidity. Governments are still keen on spending a lot of money, remember, with debt, i.e. incurring even more debt, and enlarging their budgets to pay off, not just pay off the obligations they incurred due to the pandemic, but support the economy to get it out of a slump of underperformance that we have seen over the past 12 years. Apologies, by the way. I understand some of you might be getting blurry screens. We will work it out in by our next session. Now, next slide. Governments have money, and there's still a lot of liquidity from central banks, and there is corporate liquidity as well. Just the 7 biggest companies in the US have $500 billion between them to prop up their own stocks, and they're going to do it because those stock buybacks, as we call them, they have been the main engine for pushing equity returns up. So if you're a CEO, an executive sitting in your office, being compensated with stock options, and all you have to do is use some of that cash your company has to buy back your own stocks, and push prices up, you're probably going to do it. We have the highest, S&P 500 companies have the highest amount of cash they have had in the past 20 years. And they do intend to use a lot of that to buy back their own stocks. So that should keep, put at least a pillow under, a safety net under equity prices. And consumers are very liquid. Look at the right-hand side, the deposits as a percentage of disposable income in the US, and that is an historically high 95%. So consumers have a lot of money to put in, and anybody who's been watching markets know that in the past 2 years, a lot of people have engaged in trading activities, anywhere from day trading to propping up their retirement accounts. And that's not all. Next slide. Private equities have money. Okay, they might not throw it directly to stock markets, but they do have money. They have nearly 2 trillion of unallocated capital. Okay, so that is a lot of money waiting for opportunities. Yesterday, the market was down intraday around 12% from its recent peak. And interestingly enough, in the last 2-3 hours of trading, it bounced back up another 4% to close a bit higher. This is a lot of investors who were just, eager and waiting for the minus 10% to start pouring money back into markets. Next slide. So, when we're talking about liquidity, the numbers you really need to remember is that we have added, central banks have added nearly 22 trillion of liquidity into markets, but that has translated into 105 trillion for bonds and equities. Okay, so the central bank is there. It is definitely, helping to push prices up. It's a very good psychological driver, but it's not the only driver, the only thing that drives value higher. For every dollar they spent, they got $5 back in terms of market value. So keep that in mind, because that means that, again, there's a lot of liquidity and other things that can eventually take from the Fed, and we can go back to markets without the Fed's manipulation, which is what most of us grew up in a bit before 2008. In the next slide, and why do I think that even, when markets drop a lot, the Fed might intervene? This is the amount of exposure to equities US households have. Why are we looking at US households? Because that's what the Fed looks at. And they have the highest equity exposure they have had as a percentage of the total assets historically since 1951. So, if Americans are angry at Biden now because of inflation, they can get a lot angry before the midterms if they see the value of their retirement accounts dropping by 20 or 30%. So yes, there are pressures on the Fed to fight inflation, but there will also be some other pressures to keep retirement savings safe. Now, let's turn the page a little bit and let's talk about the global economy. The global economy is expanding at a very satisfactory pace. This is our in-house nowcast model. Nowcast is a fancy word for our prediction for where GDP is right now. And we think that the US is growing by around 4% per annum, the UK by 5%, and the EU by 4.3%. So before the pandemic, everything was growing at a meager 1.5 to 2%. So we're still in the rebound phase where things look a lot better than they used to look on average. Next slide. Having said that, things are very dispersed. So the US is returning back to its trend, the left-hand slide, as if the pandemic didn't happen. But the UK, for other idiosyncratic reasons as well, it's more exposed to weaknesses in supply chains, has yet to catch up with the previous trend. And this is the bigger picture here, is that economies used to be a lot more harmonized. I'm showing you, two economies that used to go, that used to perform very closely together. And now you see this this disharmony amongst in terms of economic performance. So this is a feature in today's economy, and it certainly will affect both investment. It's also going to affect the supply chains and lives. What I think personally is that the UK is spending a lot of money and will eventually catch the previous trend and sort of go towards it. But it still has to deal with the country's idiosyncratic factors. Next slide. Where the real problem is emerging markets. Emerging markets have taken a terrible hit. They suffered more from COVID than developed markets. Remember, a lot of them don't have access to vaccines. And in this chart, you see the developing world's GDP as a percentage of advanced economy GDP, and you can see that it's barely budged over the last few years, and certainly over the last 2 years they have lost some momentum. So some people are always saying, well, okay, we should look towards emerging markets for growth. Currently, the economic data doesn't support that, and the hits these markets have taken from COVID are significant. So are we anywhere near fixing those supply problems? Next slide. The answer is we're near-er, but not there yet. Supply chain conditions, they were tight, and that chart that does not really account for Omicron, which moved very fast. But they were tight back then. They were sort of improving though. So we're seeing, better container throughput. We're seeing some slower prices for bunkers, the fuel that tankers use, and that sort of thing. But we still have ways to go, a lot of ways, in fact, before we have any semblance of normality in supply chains, which should also, at the very least, alleviate inflationary pressures from the supply side. Now, what it all means. Next slide. The market is near all-time highs. However, inflation has turned central banks hawkish, and now you would need really a very big retrenchment for to see intervention by central banks. What will drive markets, or what will possibly drive markets in the near future, is residual liquidity as opposed to added liquidity. I would not expect the Fed to add, or other central banks to significantly add to liquidity in the near future. The economic rebound, the big rebound has happened, and now we're in the slowing down phase, but still above average. And keep in mind that the road ahead is not a straight one. In fact, with the Omicron, there's no telling. Recovery could be taken back into 2023, or we could be back towards some sort of normality in the next 90 days. There is really no telling with this pandemic, which means that there are still opportunities out there, because a lot of scenarios have not been priced in. Some people bet on the very negative scenario, some people bet on the very positive scenario, and that creates markets. Now, final slide. Lots of positives, lots of negatives, a few positives like liquidity. So why stay invested and not just wait for the hullabaloo to be over and invest back in? First of all, this volatility actually creates opportunities for the good managers. Okay, the last thing you want if you're a manager with an imagination is a straight line. There's nothing you can do about it. But there are good managers out there, some of which we engage with for our portfolios below our asset allocation, on asset allocation choices. And there are good managers out there, and they can make money for clients over the longer term. Second, cash is not an option. With inflation over 5%, and which could well stay for the next couple of years, if something stays in cash, it can lose 5 to 10% of its value. If it goes to bonds, you have to settle for low yields and the possible bond re-rating. So, equities are still where a lot of investors prefer to be in. We believe liquidity will remain ample. We believe there are still strong incentives to save the stock market if it really starts going down. And that's really the final point. The Fed can tolerate a lot more volatility than it used to, but it cannot tolerate infinite volatility. So keep that in mind. Well, quantitative easing is not there, but the Fed may well intervene when it sees things still going south, and that's a very powerful incentive to remain invested. With that, I'll pass it back to David.
Thank you very much indeed, George. Let me just echo George's apology about the quality of the visuals for some people joining us via Zoom. As I think we put in the chat, this is the first time that we've tried to do a dual presentation via Zoom and LinkedIn, and it appears to have affected the quality. So apologies for that, and we'll make sure that's fixed for next time. We've got 5 minutes or so just to pick up some questions, George, and I'll try and use some of the ones we've had in advance and pick up some of the ones that we've come through. Let me combine a couple for you now. So the first question is, are the economies of the old world, primarily Europe and the US, a busted flush? Is it time to pile into the Far East emerging markets and the much maligned BRICS? And we've had another question, which is about Chinese stocks in particular, having taken a hit with the pandemic and severe lockdowns. What is your view of the future for China? So is it a case of, now is the time to be going into emerging markets and China in particular?
I think an emerging market allocation is always good for most portfolios, to remain diversified. And yes, overall growth rates over there are bigger. Having said that, and that was the last part of the presentation, those markets are still suffering from a lot of consequences of the pandemic. And also we see this great big Chinese rotation out of being the world's manufacturer into being a new thing, which is a key consumer. you know, all of this has positives and negatives, but to be quite frank, I do not see a catalyst which would say, okay, we should take our holdings in developed markets and then put the core of our holdings in emerging markets. In my view, emerging markets are still have a place in the portfolio, but it's more peripheral to developed markets. Companies in developed markets are well researched. They can take advantage of global growth rates as well. You know, a lot of them do have presence in China and those countries. So I'd say even if the local economy underperforms the emerging market economy, those companies are global behemoths, are global conglomerates. They're still taking advantage of what is happening in the emerging world, but they do it with a bit better, not better, a bit more sorry, severe governance, a bit more strict governance. That's the word I was looking for.
Excellent, thank you, George. And I think it's probably also fair to say that the Chinese economy does have significant problems with its property development sector. You know, some very large companies which have taken on a huge amount of debt to aid the build out of Chinese infrastructure over the last couple of decades are now really struggling to not just refinance that debt, but actually just to pay the interest that's due on that. And we see, don't we, quite a significant stress in that part of the Chinese market. So that was a question for you, George. I don't know if you want to expand on that.
My connection just blinked out for a second. Can you repeat that?
Don't worry. I was just talking about the Chinese property sector and some of the strains on the companies in that area.
Okay, so yes, the Chinese property sector accounts for 6% of GDP, and it influences by some measures around a third of Chinese GDP. So obviously it is of concern, but the government right now does not. The primary goal of the government is to rotate the country towards a new paradigm successfully, and it's less mindful of the impact in major economic sectors. And anybody who's familiar with Chinese history knows that this is very consistent with the way they would operate.
Thanks, George. Let's take another question. We'll try and squeeze two more in. How much would inflation need to fall in the next quarter to cause a central bank not to raise interest rates in 2022 in the US or in the UK? I think our thinking is that it's extremely unlikely that we would get inflation falling, but by such an amount.
In typical British manner, David would say it's extremely unlikely. I would place the probability to near zero. And because you would need to see inflation drop in the next 3 months from 7% to 2%. And if that happened, I would imagine there would be, a big economic shock behind it that would really be the driver to change the Fed's view. For inflation to drop that quickly. A new wave of COVID, something that you can't catch with vaccines. And yes, economic activity drops like that, then the Fed will change their minds. But that's not going to be a good thing. Yeah, my view is that it's, as you said, it's very, very highly unlikely, edging towards 0%. And if anything would change the Fed's mind, it would probably be another event, and not a good one.
Okay, fingers crossed we don't see that. Let's squeeze one last one and then, George, a little lighter one. How safe is it to invest in NFTs? And for those of you not familiar, NFT standing for a non-fungible token. I'm certainly no expert in this, but it's effectively a digitized security version of what, for want of a better phrase, a JPEG. George, views on NFTs?
Yeah, so it's an art. It's a modern form of art investing. And just as a caveat, I'm not an expert, and there are people out there who can value experts. I look at the Rembrandt, I like it. I look at the Picasso, not so much. I look at the Jackson Pollock. I understand some people love it, but it's not my cup of tea. So NFTs, non-fungible tokens. people pay as much as a couple of million for pictures of bored apes. Now, the question is this art? Humbly, I cannot answer that. For some people it is, and that's what creates a market. What I can say, however, is that we've seen Bitcoin rise and now drop as some of the extra liquidity goes out and volatility rises. So what I would say is that NFTs are probably one of those new age products, and time will tell if they're going to become mainstream or not, if they're going to become regular parts of portfolios or not. From where I stand, I can't let my own taste affect that particular judgment. Time will tell, but it is certainly not in our investment radar right now.
Thank you, George. No, I mean, it's fair to say that there have always been esoteric investment opportunities, whether that's vintage cars, fine wines, stamps, whatever it is, but they are always at the mercy of their own supply and demand dynamic, and you need time to play it, to see whether there's any sort of stability in the demand and supply dynamic for these things. Okay, good. That takes us, I think, to time. George, thank you very much indeed for your contribution, and thank you mostly for those of you who've chosen to spend your time with us this morning. We hope you found it enjoyable and informative, and we look forward to seeing you again on our next session.